Welcome to Policy on Demand. I'm Scot McCandless. It is the week of July 21st, and this is your Monday briefing. This week, Congress is continuing to work on next fiscal year's government funding before leaving for its August recess, which is scheduled to begin next week for the House and the following week for the Senate. The House last week passed a $9 billion resolution to rescind funding previously approved for public media and international organizations. And in international news, the Belgian Constitutional Court referred a key case on the constitutionality of the EU's UTPR provisions to the EU's top court. On the trade front, additional tariff letters to over 150 smaller countries are expected to be released this week. A reduced tariff deal was announced with Indonesia, and negotiations continue with the EU and Russia. The USTR also announced Section 301 investigations into Brazil's trade practices. With the continued focus on trade, the effects of tariffs on inflation has drawn increased attention. Here to offer insights on this issue is Karl Russo. Karl, welcome.
Thanks for having me.
So Karl, let's start with this issue of inflation. We've been hearing a lot about tariffs possibly driving up inflation. How much of that is actually showing up in the numbers right now? And what has stood out to you in the latest inflation or CPI data?
Well, we would, as economists, expect to see tariffs show up in final prices, and it's been a little surprising that we haven't seen any of it yet. And I think I would say that that's true of this report. There's still surprisingly little effect so far. So one of the things that stood out to me was how much services prices are still driving the main inflation numbers. So they were responsible for the lion's share of that 2.7% increase in CPI. About half of that was attributable to housing, and then another third maybe to other services other than housing prices. And tariffs don't apply to services. So it really is just goods that would be seeing this tariff effects, and they added only about 0.15 percentage points of that 2.7% inflation number.
That's interesting. I'm curious, Karl, are these trends that you're seeing consistent with expectations? And really, I think what we're all wondering, Karl, is when will the effects of tariffs actually start showing up in some of the economic statistics?
So there's been some activity that we've noticed that might think there would be some delay. So in the first quarter of the year, we saw a very large increase in imports, which we think was due to stockpiling of goods ahead of anticipated higher tariff rates. And that may have allowed some companies to establish some inventory that they could sell that were unaffected by the tariffs that were imposed after that date. So they've been working through maybe some of that inventory. But I would have expected that only to last for maybe a month or so. And so maybe it's a little bit of contrary to expectations that we still haven't seen a big increase in tariff prices showing up in the final goods yet. If you look at the change from May to June, when you may have expected to see that come into effect, goods inflation increased only about 26% of the change from the prior months.
Makes sense. That makes sense. So in your conversations with companies, what's the thinking you're hearing about the connection between tariffs and inflation? And from their perspective, who's really bearing the cost of the tariffs?
So companies are wondering, how long can they maybe absorb some of these prices? So in addition to the stockpiling, companies have been trying to negotiate better deals with their own suppliers as a way of trying to pass back some of the tariff effects onto them as opposed to pushing it forward onto consumers. And I think there's a concern just, well, how long can they continue to do that? And if companies are absorbing the prices rather than seeing it pass through either to their suppliers or to final consumers, that's going to hurt profitability. And it's a question of sustainability. How long can they do that? If the tariffs really are temporary and they're part of negotiations that lead to more open trade deals and then they go away, then that might be a case in which they don't need to worry about them very much, and this is just a transitory factor. But if it looks like they're going to be around for a while, then companies are concerned that they may have to rethink their pricing strategy, both on the supply side and also to the final end users.
Those are some good ones. What other economic indicators are you monitoring in assessing the impact of tariffs?
Yeah, so one of the things that we'll be anxious to see is the first report on second quarter GDP. That'll give us a sense on whether trade flows are beginning to be affected by tariffs. That large increase in imports that we saw in the first quarter really pulled down GDP growth. We'll see if that was also passing in nature and whether or not we're back to some other more normal level. It could be that the tariffs are mainly resulting in rerouting of economic activity to countries that have lower rates, with the overall trade levels not really affected very much, or maybe we will see some substitution away from imported goods and into domestically produced goods. That's something we'll be keeping an eye on. The other thing, as I mentioned, will be corporate profits. If it looks like companies are trying to absorb those tariffs, as I said, then those corporate profits may decline. And again, keeping track of this inflation data from month to month to see whether or not something shows up there. Remind folks in inflation, it's going to be a little bit of a muted effect because about 2/3 of consumption is services and only about 1/3 is goods. And we only import about half of the goods that show up in final consumption. So there's going to be some mitigated effect, but we should see something, even something like a 10% tariff, if it were fully passed through to prices, would probably raise CPI by about 1.7 percentage points. And so at some point, we're going to look to see whether that shows up in the inflation data.
Karl, where do you think companies may want to spend their attention and focus?
I think as companies look forward to what's on the horizon, tariffs may be only part of the story. A lot of them will be looking at implementation of and modeling out how the most recent tax legislation affected them and whether or not that results in any change in what they should be doing. Tariffs are just a piece of the story. They're an important one given the magnitudes that we've had on that front, but it is just one part of the overall story of what companies need to be watching.
That's great. So, Karl, any final thoughts before we go?
One other thing on tariffs is that they have been raising a lot of revenue for the federal government compared to previous years. And that is helping to push back on some of the deficit concerns. At a 10% tariff that applied worldwide, we'd expect maybe 200 or more billion dollars a year coming in from tariff revenue. And we've seen a very significant uptick in just the last couple of months since that 10% tariff has been in place. So that's another thing that I'll be keeping an eye on.
Karl, this has been terrific. Thank you so much for being here and for all your insights.
Thank you.
And for our viewers, you can find the latest Week in Review with Chairman Camp in the description of this episode. And we are excited to have Janice Mays back on the show for this week's Week in Review. You will not want to miss that episode. Stay with Policy on Demand for more analysis from Washington. We hope you have a great week. Take care.